The best chip earnings in history, the worst chip week of the year.
What number owns this paradox? Taiwan Semiconductor's revenue just jumped 68%, the best chip earnings the world has ever printed. And in the very same week, the chip index fell into a bear market, and the memory giant that just staged the biggest stock debut in history crashed at home. Perfect earnings. Crashing stocks. One of them is lying. Tonight, 5 legends put the AI trade on the stand.
Here is what the crash hides. The earnings were not the problem. Every headline number beat. What the market repriced was not the earning, it was the spending. And that is how a $2 trillion trade broke in 5 days. The board convened in July 2026. These are the numbers the legends saw. On the docket, the perfect earnings, the crashing stocks, the history that has ended both ways, and 5 methods that refuse to agree. The verdict start with the run. The chip index had climbed 63% in a single year to a record on June 22nd. 25 days later, it was in a bear market. Nothing about the businesses changed in 25 days, so what did? Meet the machine everyone is arguing about. This is the foundry that prints the world's most advanced chips. In the June quarter, its revenue rose 34%, its profit 77%, and 2/3 of it now comes from artificial intelligence at the fattest margins in its history. This is not a company in trouble, so the trouble came from what it said next. It said it would spend more, a lot more. It raised this year's building budget to as much as $64 billion and lifted its growth outlook past 40%. Wall Street heard something else in that number. Hold it. Now the memory, the chips that feed the AI engine sold out before the year even began. One maker just posted $41 billion in a single quarter, an 85% gross margin, and earnings up more than 1,000%. 1,000%, and it still cannot make enough. That is the tell people keep pointing to. Even while printing record demand, it holds its building budget near $26.5 billion, a fraction of what it earns, choosing discipline over flooding the market. The bull calls that genius. Keep that word, discipline. It comes back and it is not a compliment. The third player lit the fuse. The world's biggest maker of AI memory just crossed 50 trillion won in a quarter for the first time ever at a 72% operating margin. Its chips go straight into the world's AI accelerators, and then it did something no foreign company had ever done. It staged the biggest first-time share sale in history, $26.5 billion on the Nasdaq, larger than any foreign listing ever recorded. The chairman told the cameras, demand is enormous. The stock opened up 13%. Remember that number and that sentence. In 3 days, they both become a warning. Then its own chief executive said the quiet part out loud. Next year, he warned, will be the worst year in the industry's history for supply, not because demand falls, because it cannot be met. A shortage that deep should print money. So why, that very week, did the money run? Even the skeptics agreed the earnings were real. A JP Morgan strategist called the chip name's earnings power, quote, absolutely rock solid. But he added the catch that becomes this whole episode. All of it rides on the giants who buy the chips continuing to spend. Rock solid today, renting its strength from someone else's budget tomorrow. Turn to the second half of the paradox, the file marked crash, because the same week those numbers printed, the tape told a completely different story. In 5 trading days, the chip index lost 18% for the month and fell into a bear market. $2 trillion in value gone from a group whose earnings had just beaten. The selling was not random. Walk the wreck with me. Start in Seoul. 72 hours after the biggest debut in history, that same memory giant fell 15% in one session, its worst day on record. It dragged the Korean market down 9% and tripped a circuit breaker. $200 billion wiped from the winner. The biggest debut in history and the worst day on record on the same stock the same week. Then, the tell nobody put on a thumbnail. The oldest name in computing fell 25% in a single day, its worst since 1987, on a revenue miss of barely 1%. And the reason is the hidden wire that connects both halves of this show. Its chief executive said customers had suddenly shifted spending to servers, storage and memory, racing to lock supply before prices rose. A company runs on a roughly fixed budget. The memory boom got so hot that buying the chips ate the money customers spent on everything else. The shortage minting billions for the memory makers drained $67 billion out of one software giant in an afternoon. Now you can read the whole week in one line. The earnings were fine. The spending is what scared people. When the foundry raised its building budget on a blowout quarter, the market did not cheer the beat. It sold the bill. Because everyone was already crowded onto the same side of the boat. By July, being long chips was the most crowded trade ever recorded in the big survey, 82%. The phrase the pros used was, "No one is short." Borrowed money to buy in had jumped 54%. When everyone owns it, nobody is left to buy the dip. By Friday, it had a name. As Asia's markets fell as much as 6%, one manager in Tokyo put it flatly, "The word bloodbath is accurate because it is across the board. So there it is, perfect earnings, a bloodbath. Which one is the truth? History has watched this exact collision before, twice." Precedent file, two names the market will never forget, and one that proves the bears can be wrong. The year 2000. The most valuable company on Earth made the gear the internet could not run without, and its revenue was still accelerating. Its best growth quarter, up 66%, landed 8 months after the stock had already topped. The peak was in the price, not the business. Then it fell 86% and took 25 years to recover. And the cause rhymes with today. In a shortage, terrified customers ordered double and triple to lock supply. Every supplier built the full amount. The sold-out order book was partly a ghost. When it cleared, half the demand had never been real. Hold that word one more time, sold out. 19 years later, the video company whose revenue grew more than 300%. That growth kept running for 2 more quarters after the stock had already peaked. Then the stock fell 90%. The lesson: when demand is pulled forward, the last perfect quarter is the top, not the launch pad. And memory carries its own trap. In 2018, the same kind of chip maker traded at 4 times earnings while revenue jumped 50%. 4 times earnings looked absurdly cheap. It was not a bargain, it was the top. The stock fell 57% while earnings were still rising. But the board cannot tell only the bear story. 18 months ago, the AI leader lost $593 billion in one day, the biggest single-day loss in market history, on a scare that its chips would not be needed. The scare was wrong. 9 months later, it was worth $5 trillion. Not every crash on good news is a top. So the board's real question is not, is the sell-off big? It is sharper than that. Is the market questioning whether this demand is truly real? And is it right to? 5 methods, 5 answers, take your seats. 5 chairs, a growth man, a value man, a stock picker, a macro trader, and a cycle master. Chosen for one reason, they disagree violently about exactly this. First chair, the man who bought long runways and held them for decades. His rule for selling a truly great business, in his own words, was almost never. He does not score the quarter, he scores the decade.
Run the Fisher test. Is the runway real and is it long? Plainly, yes. Compute demand is a multi-decade wave, and these are the companies selling the shovels. A correction in a genuine compounder is not a reason to sell. It is the tantrum of impatient owners. But the test has a second clause, and it is the whole game: do not overpay. At the most crowded price in the survey's history, even a great runway can be bought badly.
The Fisher model scores the trade a 7. The business is a keeper. The price is the only argument against it. Buy the wave, it says, but not at any number. 1 chair down and already the split begins. The second chair could not be more opposed. The father of value investing, who trusted arithmetic over stories and demanded one thing before all others: a margin of safety.
Graham's screen is unmoved by megatrends. Price against provable value, with a margin of safety, or you do not act. And here the arithmetic reveals a cyclical dressed as a growth stock. These memory names look cheap on this year's booming earnings, exactly as they did in 2018 at 4 times earnings, right before they fell by half. A low multiple on peak cycle earnings is not a discount. It is the market pricing the down cycle you cannot yet see. There is no margin of safety in the most crowded trade on record.
Graham's screen scores it a 3, not because the businesses are bad, but because the price offers no protection if the cycle turns. The board spread is already 4 points wide and 3 chairs still have not spoken. The third chair made the everyday investor's case: know what you own and buy growth you can explain in 2 minutes. But he had a specific, brutal rule for companies exactly like these.
The Lynch drill starts with the story, and this story is clear. Anyone can see the AI demand, but know what you own. These are cyclicals, and the Lynch rule on cyclicals trips everybody. When earnings look highest and the multiple looks lowest, you are usually near the end of the good times, not the start. The story is real. The timing is late.
The Lynch drill scores it a 6. The story earns it the benefit of the doubt. The cyclical clock costs it points. Constructive but wary, which brings us to the twist this board did not see coming. The fourth chair is the twist because, unlike everyone else here, the real investor behind this method already made his move. The macro trader who taught that you never invest in the present, you visualize 18 months out.
The Druckenmiller model never asks what a company earns today. The present is already in the price. It asks where the spending goes next, and the master variable is CapEx. The giant spending growth is set to slow from 76% to 25% into single digits, not collapse, deceleration. And this method sells the leaders before that is obvious. The real money running this playbook did exactly that. Out of the general-purpose chip king entirely into the next layer of silicon. The leadership is changing hands.
The Druckenmiller model scores it a 5 dead center, and it is the most uncomfortable 5 on the board. It says the correction is healthy and the easy money in the leaders is already over. A hold that is really a rotation, which leaves one chair and the one question this whole session has circled. The final chair does not predict, he locates. The cycle master who asks only 2 things: what are you paying against what it is worth, and where in the cycle are you standing?
The Marks memo begins with second-level thinking. First level says great companies, buy them. Second level says everyone already knows they're great and it is the most crowded trade ever recorded. The most dangerous thing you can do is buy at the peak of popularity when every good fact is already in the price. And yet here is the nuance: the options desks are hedged, not euphoric. This is late cycle defensive weather. It is not the capitulation bottom where fortunes are made.
The Marks memo scores it a 4, not a crash call, a posture, defensive, patient, waiting for the crowd to be wrong in the other direction. 5 chairs, 5 methods, now the tally. And the real money agrees the board is split. The method lands at a hold. The money has been leaving the leaders for a year. The macro legend fully out, one famous fund trimming the chip king in 11 of its last 12 quarters, another cutting it hard while a single big name keeps buying. And the crowd sits at a record 82% long. That disagreement is the read. So here is the board: Fisher 7, Lynch 6, Druckenmiller 5, Marks 4, Graham 3, 5 methods, one company they all know cold, and they land 4 full points apart. A composite of 5 and a spread of 4 points. That spread is the answer. The board did not split over whether the earnings are real. Every chair agreed they are. It split over time. The verdict in the board's own language: hold, perfect earnings and a price that ran ahead of even those earnings into the most crowded trade ever recorded. A healthy correction inside a real trade that is also dangerously late. Nobody was lying. The earnings told you the business. The crash told you the price. And 3 things decide which one wins. 1. The giants report over the next 2 weeks. Do they reaffirm the spending or blink? 2. Does memory pricing hold or roll over like every cycle before it? 3. Does the crowd finally capitulate, the one thing that would flip the cycle master from cautious to greedy? Flip those and a 5 becomes a 7 or a 3.
That is the AI trade, understand. The rule of this board never changes. We give you the coldest read on Wall Street, the legends methods, the real money's filings, the crowd's mania, and then we hand you the gavel. So you tell me, healthy correction or the top of the trade? And which giant should the board judge next? The verdict is sealed. Your comment is not.